Good evening, everyone. Welcome back. Let's begin our discussion on stimulus funding for supply chain in post-COVID scenario. And now, welcoming our panelists, Mr. Aditya, Chief Executive Officer, TallyX, the moderator for the session, Mr. Roberto, Founder and CEO, What If, Mr. Maninder, Director, Derby Group of Companies. I would request all the delegates to keep posting their questions in the chat box. Over to the panel now.
Thank you, Shivani, and all of you. Welcome to this session. I just want to briefly introduce Maninda and Roberto. Maninda has been a career banker, particularly on the transaction banking side, playing various leading roles both in Latin America, in Asia, and in the Middle East. Maninda heads as the director of the Derby Group of Company, where they advise on trade finance for a number of different initiatives in the Middle East and Africa. And Maninda also has done transaction banking by heading Emirates NBD, the transaction banking division in Dubai, as well as advising various governments on trade policy. We're very pleased to have Maninda. And I'm going to now briefly introduce other panelists, Roberto Manconi, who's been a career banker as well with Deutsche and other banks in Europe. More recently, Roberto initiated and led the WeTrade consortium, based out of Europe, which had about 14 member banks. So he was really really instrumental in setting up and running and getting that whole initiative off the ground, which is one of the largest trade consortiums run on blockchain today. He now runs a consulting company and also is a senior fellow in Oliver Wyman, looking at both blockchain and trade, apart from which he's also a professor and teaches on this subject in Europe. Very pleased to have you, Roberto.
Thank you.
Okay, I think without further ado, we'll set the agenda. Today, we're going to talk about what happens in supply chain, particularly in a post-COVID scenario, and what industries and governments can do to create further stimulus in economies. Because we think this is going to be a key a key part of the new DNA of trade, particularly how governments actually create that bridge between those who need the funding and basically the ability for organizations to actually leverage stimulus programs in a meaningful way, but also for corporations to drive their own stimulus, particularly because of the shifting sands of supply chain. Even pre-COVID, we saw a lot of breakage of international trade agreements and people much more reverting to bilateral agreements and also generally trade protectionist policies starting to emerge, even prior to COVID. And I think probably the situation has only got worse, but over to you, to the experts. So I'm going to start with you, Maninda. If you can describe, what you see as some of the major impacts that leading into COVID and then post-COVID on the global trade and supply chain landscape.
Thanks, Aditya. And thanks for the introduction. There's a part of that which, let me introduce myself as the other hat. I am also the CEO of a group of companies, 4 of them in nature. And we are involved over there with a lot of trading activity and some degree of manufacturing. So let me come to you from that aspect of the post sort of COVID or the COVID sort of scenario. What we found in our entire sphere of activity was we had not perhaps realized it to the fullest. In our supply chain, there was so much of concentration risk in terms of which way we were buying from, and it became historical rather than looking at multiple sort of channels, multiple geographies, multiple sources. We were concentrating on the cheapest and old adage kind of situations that perhaps in that head in the sand, nothing can go wrong. And from the supply side of it, we were concentrating on things which were people comfortable with, and it was going very naturally and rather well. So the impact that occurred to us over there was very clear. There was concentration risk on both sides in terms of entities and in terms of geography also. And this impact made us very quickly rethink as to how we have to operate going forward, not only in a pandemic situation, but also in a situation where we need to think in much broader an aspect, which we're perhaps not doing so earlier, despite having sort of the experience on it. And it was just the growth factor that was propelling it, moving towards development of business rather than concentrating so much on the supply chain. So that impact has gone right across multiple industries. And in fact, we will perhaps dwell upon this a little later. It has helped in terms of where the blockchain, digitization, and sort of non-contact related activity as far as cross-border or domestic trade is concerned. So some of it, big impact. It really came very quickly. We were not fully prepared for it because we hadn't thought beyond our nose, but we reacted very quickly because of experience and because of the fact that perhaps I had some geographical dispersed industry experience, whether in the banking scenario or otherwise, and we could dwell on it and take care of it. But the impact was substantial, is what I'm trying to say.
Yeah.
Thanks, Belinda. Terrific insights on both concentration risk as well as agility as being two key points, which I'm going to get back to shortly. From your perspective, Roberto, given that you've seen the industry, particularly in Europe and also on a global side, what are some of the impacts you're seeing in terms of in your role, both as a strategist with Oliver Wyman and also with your own consulting?
The contribution I'd like to bring in this global fintech discussion that we have is obviously every continent, I think, and every economy has a different way of dealing with the crisis and dealing with the uncertainty, right? In Europe, I think probably the majority of the intervention has been towards preservation of the jobs of companies, right, with several instruments aimed at supporting companies and continuing to maintain employees, so without any termination of the employee contract, receiving funding conditioned upon the fact that the companies will maintain those jobs. So the situation in Europe, if you want, is certainly not similar to the one that you see in the United States, where you have had an enormous increase in unemployment. But it's been until now particularly stable, and until now means we expect the situation to be the same until September. Different also from the situation in Asia, which of course was beaten badly in certain sectors, being the majority of the outsourced activities of the Western world developed in the Asian market, right? So I think Europe so far is enjoying in its own way of protecting the working class and protecting also society in all shapes and forms by increasing public debt. Probably had a valuable reaction at the moment. Now, what are the consequences, though? That this is a false stability in the sense that if this stimulus program or this intervention by government will stop in September, October, because obviously the public debt cannot increase infinitely, then of course at that time you will have some small, medium enterprises really suffering, because once they stop receiving the support, definitely they are facing a situation where on average they have like 50% less revenues than last year, right? 50. Now, this probably is not a situation that creates a lot of issues for large corporates, for the Fortune 500, Fortune 1500, because they were all able to access the debt capital market to secure additional funding, to secure liquidity. Therefore, large corporates have the capability to manage their working capital situation in a stable manner, even if they may have a drop in revenues or drop in operating profit. Liquidity for large corporates is not an issue. It is a big issue for small companies, of course, have only, especially in Europe, access only to bank loans. They do not have access to capital market. They do not have access to alternative way of funding, and therefore, should they struggle in terms of results and the impact, then this automatically will be translated into negative rating and therefore drying up of the loans that they can receive from banks or cancellation of facilities, right? So this is the high risk that we see now towards autumn. that's why I say at the moment, summer seems to be lovely summer, as you can probably see. Everybody is dying to go on vacation, enjoying or trying to enjoy life as it was before, like nothing happened. In reality, is simply we are postponing an issue, hoping that by September, situation will go back to normal, and then with this intervention, we have been able to cover the immediate needs. Should the situation deteriorate further in autumn, of course, it will be a completely different story.
Roberto, terrific insights. I mean, one of the key takeaways that you mentioned really resonates with my own way of thinking, which is that in this post-COVID scenario, the risk parameters for companies have changed dramatically. And like you said, the large corporates are better able to weather this storm. And therefore, if anybody is going to take assigned risk, it'll probably veer towards the large corporates rather than small and medium enterprises. And therefore, my own point of view here is that if governments or others or even banks or financial institutions are able to use or leverage large corporations as a way to drive stimulus into smaller ones, that is a viable policy, because you have somebody's collar or throat to choke, right? Which is the large corporation. But for a smaller company who's maybe unviable, it's very difficult to take risk on that, whether it's a government or whether it's anyone else, right? Or bank or financial institution. So therefore, this whole idea of injecting liquidity through the large corporate seems to have some legs based on what you're saying. Maninda, what's your view on that?
I would slightly differ, because the corporates, I'm talking here from a practical sort of experience. The corporates that I lead are mid-sized corporates. And it's something that we'll discuss perhaps later down this discussion, is that the stimulus that has come from the government, I'm based in UAE, has been tremendous. And it's been directed towards the mid-sized and smaller sized corporates because of the perceived sort of impact that it will have on you. And the support that has come through has been absolutely tremendous. The other side of the equation is exactly what you're mentioning, that the larger corporates have perhaps the ability to be able to increase that stimulus in the economy, and therefore a lot of methodologies can be involved as far as that is concerned. On the financial aspect of it, what we found personally was that liquidity was available, but the extent of working capital was getting elongated. And the requests that were coming not only from small to mid-sized corporates, but larger corporates for deferments was a lot more than what was prevalent. We thought the equation would be reversed. And we were quite surprised, because they were feeling a lot more of the impact than perhaps the small and the mid-sized were, because the pie size was smaller. So I guess experiences differ, markets differ, and so on and so forth. But there was definitely an impact in all the aspects that Roberto was alluding to, or I was alluding to. Multiple fronts had opened up, which needed to be, handled in a specific manner. But there was support. There was a fair amount of support, which that one could use.
Yeah.
Thanks, Maninda. Roberto, you wanted to say something in that as well, please.
No, I mean, I wanted to add that, of course, we all agree that somehow I think big corporates have an important role and responsibility here, trying to let the liquidity flow throughout the chain, right, of their suppliers, not only the tier one, but also all the way down to the chain. But sometimes I would say it's not easy. There are certain sectors that, no matter about liquidity, will be hit, it will be hard. Let me give an example. Of course, all the corporates, if you talk to CEOs, CFOs, or CEOs, right now in immediate strategy of emergency, they have several initiatives in order to cost cut, right? It's like operating income they have to defend, which means they have to eliminate all the discretionary spending, and that normally is travel, marketing, entertainment, but also they have to cut on fixed costs. So instead of investing in IT, they tend to
Roberto, we seem to have lost your your audio. It might be better to just switch the video off.
Okay, is it better now?
Yeah, go ahead, Roberto.
So, can you hear me now? Okay. No, I don't know what point you lost me, but I said, you know, all the. Can you hear me?
Yeah, we can hear you.
Okay,
please.
I said, considering that all the companies normally tend to focus on the operating income, therefore they cut discretionary spending, they cut investment in IT, so fixed costs, real estate, and so forth. All the sectors that were providing this kind of services or product or service, inevitably they have been hit, right? Not only in terms of liquidity, but in terms of revenues on their side. So this is one element. The other one is the working capital. Of course, the large corporates or mid-sized corporates, they tend to improve their cash cycle, as usual in this case, right? The natural tendency is to delay payment and make collection faster, which is that's the opposite of what the suppliers, SME suppliers, are looking for. So we are in a situation where the access to secure alternative funding, the improvement of the working capital, and the reduction of the operating cost, again, is increasing the potential earning per share of large corporates after the crisis. But meanwhile, it's making weaker and weaker the network and the ecosystem of suppliers, right? And I have some examples, for example, in the fashion and apparel industry, which of course in Europe is pretty predominant. If you think that the majority of the fashion houses, the famous one, the French and Italian ones, inevitably they have a lot of production also in Southeast Asia. And you can imagine, right, when you have collections that were not produced or collections that have been postponed, you know, the instant collection, if you think about the big department store like Zara or H&M, have changed completely the model. That is changing completely the supply chain. It's no longer the one that we had in February. And this will have and has right now a tremendous impact on the companies that on the other continents, of course, are struggling with less revenues, but also at the same time, less liquidity.
So if I was just to add to that very quickly, without being
Sure, please.
Roberto was very spot on over there. If I was to extend what he was saying, it was a lot industry dependent. It wasn't generic across the board. It was a matter of degree. It was industry dependent as to which vertical was worse impacted than perhaps something else. You know, like leisure is worse impacted than anything else. So, though that financial impact emanated a lot from the industry that they were operating in, and so on and so forth, and it came down from there. Right? Yeah.
Yeah, I think that there are obviously good empirical examples. Today, Jeff Bezos is again the richest man in the world. Amazon stock price is up from 2,000 a year ago to over 3,000 right now, and that's an indicator of what has continued to thrive, perhaps because of COVID and a stimulus to the online economy. Some parts of the pharma industry, food and food delivery services have certainly increased. And travel and leisure, airlines have taken a huge hit. It's going to be interesting to see how many of them remain solvent, post this scenario, even as things start to open up. So clearly, there's an uneven impact across industries, and that's another key takeaway. That we can see from there. That actually leads me kind of to the next question. I mean, we've seen some initiatives. For example, the Danish government has announced a early payment stimulus program, where the Danish government will basically provide direct stimulus to ensure that suppliers get paid instantly, right? So essentially, they extend the payment terms of the buyer by enabling the buyers to pay the suppliers immediately, right? So that it doesn't impact the small guys. To Roberto, to your point, saying that it's all very well to do a salary protection program like we have in the US, but what happens when it dries out, right? What's left at the end of that? And for there, clearly, as you look at what kinds of industries, Amazon doesn't need any government support, right? But perhaps in your neck of the woods, Melinda, whether it's Emirates Group or whether it's Etihad or the airlines and the travel and leisure industry, they're the ones who are going to need it the most. So there may be a need for the government to look at critical supply chains which can't survive on their own, and then use some form of government or it could be IFC, World Bank, ADB, EBRD, kind of facility to grant long-term credit facilities to the anchors, while ensuring that they only do it in such a way that stimulates the SMEs, right, to keep their supply chains active and running. That seems to be kind of the takeaway I got from a couple of points that you both made. Correct me if I'm wrong, please.
No, absolutely. And the point, if I was to extend what you were saying, is you mentioned the word stimulus a lot. And when I talk to friends and business associates cross-border, that stimulus is such an extended word that there's absence of clarity on it. So what is it that is available? What is not available? How far will it be available? And so on and so forth. So, for example, when I'm sitting out in UAE, the guidelines are very clear. This is the stimulus that will be there. This is what will be done. This is what you can avail. And it's not that only in your sector this is available. It was across the board, and everybody knew that whether the banks have got stimulus, and if that stimulus is available, what is the stimulus available, which the users in turn could say, listen, this is becoming available, so I need to take it on if the bank was not extending it. And that clarity of guidelines was very, very, very necessary.
Yeah, I totally agree. In fact, I kind of did a dipstick by checking with, let's say, banks in India, with a couple of banks in India. And although the government announced a 3 lakh crore package for stimulus, a part of which was supposed to go to SMEs, the banks don't know how to avail of this, because you've got a government diktat which says thou shall lend. At the same time, the bank's credit policies haven't changed. So they're stuck between a rock and a hard place, saying that, look, I can't lend to these guys because they don't meet my criteria, right? And there's no sovereign guarantee being provided by the government saying that, look, we will take this off your balance sheet. So that's not the case, right? So there is a gap here, but there's also an audience question that basically has come up, which coincides with the question that I also have, which is that what is the role of technology to basically address some of the highlighted gaps in supply chain finance, and how can the industry transform and use this as a means to actually accelerate that transformation into a much better future, both for the anchor buyers and the suppliers. So over to you, Roberto. What do you think about the role of tech and what tech can do, particularly with your prior experience of having created this massive consortium in Europe?
I think technology has a role regardless of the moment that we're living, and regardless of the COVID impact on the economy, right? And I know how many of you, if we think specifically about trade, you probably have read about, or maybe not, about some scandals of a company called On Top and another one called Agritech, which of course they were documents fraud in a trade finance deal related to oil and gas. So they were false documentation related to the trade that never took place, that involved also an important bank. So I think in general, anytime you have trade, international trade, which requires a lot of documentation, from invoices, purchase order, packing list, certificate of origin, custom duty, port authority documentation for release. So anytime you have a huge, massive amount of document in duplicate or triplicate copies that has to go to the buyer, to the seller, to the bank, to the shipper, to the freight forwarder, you are prone to increase the operational risk, right? Anytime you have documentation going from hand to hand in the traditional way, you have an operational risk, you have a possible fraud risk, and you have inefficiency, right? And this we had even before the COVID, obviously. Now even more, I think that we have seen in certain activities during COVID, we were all forced to speed up and to shift towards some sort of digitalization of processes. Now, let's be honest, it's not that the world became digital all of a sudden in 2 months just because we work from home or because we have Zoom connection or WebEx connection. That is not digitalization. That's just intensive uses of tools that already existed before, right? And so we change our mind and our propensity to use that, but that is not innovation. Innovation requires now to re-engineer processes. Innovation now requires the fact that maybe even if it's not COVID, we need to be prepared in terms of business continuity, in terms of disaster recovery. We need to allow companies to be able, in a seamless way, to switch from one model to another, in a seamless way to switch from head office to remote data center to work from home also, guaranteeing security, data protection, protection against cyber hacking, something that, let's face it, we haven't done in these 3 months, right? No one company or countries have been able to approach these solutions. I could say, I will never mention the names, but I'm convinced in the last 3 months, in front of an emergency, most of the chief information security officer, most of the data protection officers in many companies have closed one eye or two eyes because their policy did not allow to have people handling certain documents from home or handling certain data from home, right? And nevertheless, we did it. We need it anyway, otherwise we really would have stopped the world. I think now we have the capability to use technology existing and to re-engineer the processes in order to have alternative models that still guarantee continuity, still allow people to produce and contribute in a proper manner, and at the same time also protecting the relationship and the trade activity, regardless if international trade or B2B or B2C. So yeah, technology has a tremendous opportunity right now. I really hope that in the disaster that the world is living because of this event, there is definitely much more acumen and much more willingness to sit down and prepare for something else that may or may not happen, a few months from now or years from now. I think it would be pretentious and stubborn on our side to believe today's COVID and nothing else will happen in the next 2 or 3 or 4 years. We have seen a lot of epidemics or pandemics maybe confined in the past, but it's pretty clear that every 2 or 3 years there is a potential disaster hitting the world. In a globalized world, this is a confirmation that we need to re-engineer the way we use technology.
Thank you for that perspective on technology, Roberto. I'm going to get back to you with another question around securitization of trade assets. But before I do that, let me flip back to a business question, which is coming from the audience, which basically says, and this is for you, Maninda, what is expected from governments across the globe in order to resolve cross-border supply chain issues, particularly on taxes, permissions, compliance, and local regulations, trade treaties, etc.? So is there something that governments can do really in the way of laws, regulation, compliance to help alongside the technical things that that Roberto talked about? Because these two need to go hand in hand. There's no point having the technology ahead of ability to deploy it, right? So what's your view there?
Very good question, whoever put it out there. So it's sort of mixed bag between government stimulus and, if I may use the word very broadly, protectionism that has reared its head over the past, or had even reared its head prior to all this the situation sort of occurring. And we saw increasing tariffs, quotas, embargoes, so on and so forth over there. But my thought process is a little bit more esoteric, if I may use the word, in terms of government intervention. At the end of the day, cross-border trade has to happen. And why is it to happen? Because every country is not self-sufficient, or if I may use the word, proficient in every industry. So if there is concentration on proficiency on what that country has, whether it's mineral wealth, whether it is vapor, whatever else that might be, and if those factors are put together to propagate what is the inherent strength of a industry or a set of industries in that country, that will increase the propensity of cross-border trade to continue, and therefore all this sort of within your own borders kind of situation will not happen. And that could extend even to food security. Everybody cannot produce everything that needs to be consumed. It will be something or the other somebody will have more and somebody will sort of have less. So to answer that question in its entirety, as a policy question rather than as a specific question to government should do A, B, C, D, governments really have to look beyond their borders and develop policy according to what their inherent strength is and what they lack, and therefore ensure import of what they're lacking and ensure that the world remains flat. The old adage, the world is flat. That will continue. Otherwise, this protectionism is not going to benefit anybody in the longer term.
Thanks, Maninda. That actually sets up for perhaps the last question back to Roberto, which is that we need democratization of the ability to invest in trade assets. And we've clearly had the blockchain consortium who've attempted to tackle it in one scale. But today we're seeing, for example, tokenization or securitization of real estate assets Why can't this be applied to trade? Can we apply the ability to securitize trade assets and therefore make them more readily available for a larger investor class to invest in them, and therefore to bring trust back into the industry? Do you think that's possible?
Well, the question is very valid, and I think this is the goal of the vision that I think many of us had in the journey that we have embarked since the idea of using blockchain for trade was developed. Now, ironically enough, I think 3 years have passed by since we start talking about the usage of blockchain on trade, right? I mean, the We Trade project, where I was involved, started in 2017. Marco Polo, more or less the same time. Congo for commodity trading using blockchain as well. And then Voltron Contour for digitalization of letter credit as well, more or less at the same time. So I think we can draw a line now. And after 3 years, we can question ourselves, did we reach what we wanted to achieve? My answer, similar to the one that I gave in 2019 when I left We Trade, is no, not yet, right? Not because the technology is not robust. I think the benefit of technology and the benefit of blockchain is that we have been able to demonstrate that several billions have been invested in enterprise blockchain solutions. The solution is technically viable and stable because many of these solutions went in production and they are offered and used by clients. The limitation that I see nowadays is that the stakeholders behind these initiatives are the same stakeholders that try to maintain the status quo unchanged, right? So as long as you have consortiums which are basically driven and owned primarily by companies in the same sector, being banking or being insurances or being logistic, there is inevitably the fear of cannibalizing your own business. So you do want to change, but you do not want to disrupt, right? And therefore, it's difficult really to go towards the tokenization of assets, towards a maximization of efficiency. It's difficult to go towards disintermediation of the trade, which inevitably represents a big portion of the revenues generated by traditional business. I think what I see today, and this probably will be also the future going forward, if you look at the Gartner charts and many other examples, is that we will see always less and less and less consortiums being created. We didn't see any new consortium born last year, for example, but we will see companies or enterprises, also fintechs or new entrants using the technology to develop an application that creates value to the final user without necessarily the need of a consortium, right? So we have seen already some examples, right? And this will allow at this point to create a solution where an importer and exporter can see the benefit, and probably they don't need necessarily a bank for the financing, but you probably can have solutions that create tradable assets, tokenized assets, which can find also interest by investors directly, right? And that would be the first disintermediation. The chapter, just to conclude, the chapter we have not seen yet, but I think has a huge, enormous potential, and there is a lot of interest lately, if you look at that, is the concept of the stable coins or CBDC, the central bank digital currency. That is opening something completely new. Until today, I think all these trade platforms, no matter if it was one of the ones that I mentioned before, had one fundamental issue, that once you have to execute a payment, you have to go through a bank, which means the SWIFT system, the SEPA system, the back office of the bank. You don't have an instant payment that confirms that the trade took place. Once you move into stable coins, where you don't have anymore the risk of volatility, the risk of convertibility, you have a stable funding. At that point, that risk is eliminated. Then you can complete the circle if you want, and then allow also counterparts dealing directly with tradable assets with an underlying info token, which allows also the possibility to be tradable throughout the supply chain and the suppliers.
Thanks very much for that, Roberto. I think that was absolutely spot on in terms of your observations of the way forward, as well as a great commentary from Maninder in terms of the state of the industry and where it's going. I believe we are out of time right now, so we probably need to wrap this up.
As our discussion has come to an end, I would just like to conclude by thanking all our panelists and our moderator. Thank you all our delegates for participating in this session, and we hope to meet you all again for our upcoming session. Once again, thank you to our sponsors, SBI Mutual Fund, Bank of India, and iDesign. Thanks a lot. Good night.